Friends, practically what is to be done? It is all okay. It is all the process. This is the risk and this is the way we have to gather the information. But what is to be done? As here, we are not the full-time investors. Most of us are retail investors and we have something else to do. What you have to do or what we have to do? Let us see what are the options. One is simply you can study about the sector or government policies or company actions or about with the proper valuation technique, how companies value. You can educate yourself. For that self-education, you can go through different media channels, either it's a newspaper or to gain the knowledge, the books. But when I'm talking about television and media, one has to be cautious. Because friends, I'm always seeing it, I'm going through many investors' portfolio frequently, but I seeing that the portfolio is consisting of 100 stocks or 50, 60, 75 n number. What happened? Many of our friends end up in seeing the TV, whatever this is the pick of the day or pick of the week and etc. So they keep on accumulating it more and again they are investing in the mutual fund. If you analyze that portfolio also, lot of duplication is taking place. In the end, non-performances is taking place. So be careful about the free advice. In free advice, you are getting excited and accumulating lot. If you are accumulating lot and your portfolio size is big and as well as getting duplicated by your mutual fund portfolio, and you are going to underperform. Either you can go by a very simple way of investing in a mutual fund. Either you can take a small and mid cap or large cap, depends upon the returns you are looking for. But cost wise, return wise, a well managed direct equity with a proper portfolio management technique is going to give higher returns. Another is equity advisory fund. You are not able to track and you are not able to identify. There are the guys who can identify. Or you want to give your portfolio to somebody, that somebody is absolutely supposed to manage your portfolio for them and they have to assure you the returns which you are expecting or they can envisage. Let us talk about equity advisory fund. Normally, equity advisory fund, they will give you the name of the stock and their investment rationale, allocation percentage, target price, and quarterly updates or any other specific information about the company if anything extraordinarily it happens. But friends, what happens is many people are subscribing to the equity advisory funds, but every person's return is different from another. Even though equity advisory fund is giving the same name of the same stock, but portfolio is managed by individuals, they are all not managing in the proper way for the various reasons. Because of that, the returns are absolutely varying. Let me tell the one example. Suppose somebody is buying a share, one advisory firm is giving a share for 100 rupees, saying the allocation is the 10%. The investor is buying initially 2% because he is thinking if it goes down and I can average it more. But share price goes to 110 or 120, he is scared and he is not buying more and he is stuck with the 2%. But share, let us say it goes to 200 rupees, maybe advisory firm must be thinking it can go up to the 500 rupees, but investor may be selling it at 150 or 175 or 200 also. But possibly the potential may be 400 or 500, may be better than that forthcoming recommendation. The old stock itself is sufficient to spearhead that portfolio. But all the time we are here talking about or reading about the multi-baggers in newspapers and television. How many times you are hold on to that real multi-bagger returns for that successful stock? The simple reason is you don't know where to exit or to keep it or not, or to go for a new stock. This is the dilemma most of the people are having.